Whether it's stocks, bonds, or even the once high-flying world of cryptocurrency, 2022's first 6 months have gotten off to an historically bad start, made worse by the fact that, with the exception of some commodities and the US dollar, there's been nowhere to hide. Today, the RLS boys first review just exactly what has happened. We then pivot to talk about what may come next, whether it's the markets or the economy, especially on the questions of inflation and a possible recession. Finally, with all that as a backdrop, we explore possible steps you might take right now to better position yourself for what may lie ahead. Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson and Erik Olson. Guys, I'm happy to be back. I missed you both the last 2 weeks.
Yeah, we're happy you're back too,
Likewise.
Roshan.
So,
Yeah, glad to have you back.
you guys, anything interesting that you did or fun on the 4th of July weekend?
Adrian, how about you?
So Saturday, my friend moved into his new place in Arlington, so it was kind of a little bit of like a housewarming get together. So that was nice. We went out to eat. That was a good time. Saturday, went to the pool. That was really fun. Played some basketball. So just got to do a little bit of everything I like. I'm also in the process of moving as well. So my apartment's just got a bunch of like boxes everywhere. So I'm just gonna be tackling that this week. So moving and celebrating the 4th of July just went pretty well for the most part. Just being able to do a little bit of both, just trying to stay on track because moving's definitely not fun. But if you do it in advance, it makes it a lot smoother.
Oh, that's great. For whatever reason, Adrian, wasn't thinking about the timing of your move. That's great. So I've been without my bride here for a couple of weeks until she came back a couple of nights ago. She was helping her mom, who's in an assisted living facility out in Southern Cal, and so just trying to get the place looking in shape because I don't know about you guys, but when I'm batching it, I don't necessarily meet the extremely high standards that my wife has for how frequently things should be tidied up. So I left myself a lot of work for the weekend. Didn't have as much time to just chill and enjoy it. How about you?
Yeah, well, Erik, I'm with you on that. Although I'm probably not as messy just because I'm probably eating fast food while she's gone and just throwing it
I
out.
feel that.
but but yeah, similar. I can understand your cleaning frenzy at the end there. But no, it was a relaxing weekend, pretty much at home. Did take the kids to the pool. I actually took my son to play basketball one night, so it sounds like I got to do everything Adrian did, except I didn't have to
Mm,
deal with moving. I always say, and I may have said this if we
mm.
talked about moving before on here, the only consolation I have when I am moving is I think, well, at least I'm not a mover. So it's a one day thing for me.
Yeah, I was really hoping during this like this move out process, I'd find my old headphones, but it never came up, so they're gone. So that was a little bit of a bummer because that's one thing that helps out when you're moving. You find all these things that you lost in the past, but that was my case this time. But it should be pretty
Mhm,
smooth. I'm just
mhm.
in the same apartment complex, but I'm just gonna be downstairs because it's gonna be a little bit easier with because I have a dog. It's gonna be easier to take him out, and we'll have two levels as well.
Mhm,
So a little bit more square
mm.
footage never always helps out.
That's great.
There you go.
Excellent. So, guys, I'm really excited about our topic today. We're doing some investment talk today, doing a a mid-year review, talking about where things have gone this year, and then we're going to talk a little bit about where uh, things are headed and what you as an investor can do about it. So, I'm excited about this topic, and we're switching formats a little bit. So, for all of our listeners, we would love your feedback on what you think. We're trying something a little different where we're going to have one of us take the lead on the topic, almost like they are teaching the others, and while the others are going to jump in. So this week with this mid-year review, we've got Professor Olson leading the way, and he's going to talk to us about where the markets have been, where he thinks they're headed, and Adrian and I will either be good or bad students depending on if we agree with you.
All right, that sounds great. I think then next week we should try another format where we sing different parts of what we're doing, just kind of see what the audience reaction is to that.
I,
Well,
I
okay,
think we'll
not
lose all
maybe
of our
that's
listeners.
Just gotta we gotta push Eric to the edge with the what if. That was always like a running joke we used to do at university. Just make up crazy scenarios like what if this happened, and just try and get like a response out of the professor.
Oh, that I love that. I love that. So yeah, so I'll look forward to some what ifs today. Well, so listeners, this is let's just start by acknowledging this has been a pretty tough start to a year, and on a variety of measures. And so if you're feeling a little bit of discontent or uncertainty or fear or what have you, that you shouldn't necessarily be too hard on yourself about that. It has been an unusual start to a year, and it's not as though it started on January 1st. We've had a bit of a lead in to all of this, but let's use calendar year numbers for much of this conversation. Let's go through it. So for the S&P 500 as of the end of the second quarter, so we're talking about June 30th measurements, the S&P 500 was down by 20.6% to year to date. That puts it into bear territory. And that's the biggest downturn in that to start a year for those first 6 months since 1970. But of course, the S&P 500 isn't the only measure of stocks, and so there's others. The Dow Jones Industrial Average, that's made up of what tend to be larger and tend to be more less volatile stocks somewhat. That's down 15.3% to start the year. That's the deepest decline in that index since 1962. So we're talking in this case now 60 years looking back. And if we look at the NASDAQ index, the NASDAQ composite, that was down 29.5% to start the year. And the Russell 2000, which is the index of the top 3,000 largest stocks minus the 1,000 largest stocks. So we're talking about, for the most part, small stocks. That was down 23.9 for both the Nasdaq and the Russell 2000s. Given the inception of their indices were later than those of either the S&P or the Dow Jones, those are the worst starts to the year on record for those two indices. Now, if it was just stocks, that would be one thing, but it hasn't been just stocks. So bonds, what was once upon a time known as the Barclays Aggregate Bond Index, now Bloomberg Aggregate Bond Index, that started the year down 10.7%. So all of you who had said, hey, I'm conservative or moderate conservative, and I have, let's say, 60 to 80% of my portfolio allocated to things that are supposedly safe and less susceptible to downturns, well, you just went through the worst downturn in that index since it was first developed in 1975. And if we look at more broadly, leaving aside that one index, by some measures, the downturn to start the year in bonds was the worst since 1840. So with these sorts of precedents, and first of all, just the extreme nature of these downturns, and that they're collaborating together, that's quite a powerful punch, a 1-2 punch to start the year. Let me add one or two more things, then, gentlemen, you can respond. But if it were just okay, stocks and bonds, that'd be one thing. But what else is happening? Well, there's been a frenzy about what we had talked about was cryptocurrency. We spoke about that for a couple of times. And since the peak, I'll just use Bitcoin because it's by no means the worst offender in this. From its peak, not from the start of the year, but from its peak in late 2021, that's down over 70%. So we can talk about any variety of categories. The one place that has been something of a haven has been commodities, and they're most especially, I would say, in the energy complex, although it's also true of some of the agricultural commodities as well. So what a start to the year, gentlemen.
Yeah, the first half was rough, but I'd add in there, you said commodities, but I guess also a performer, so to speak, if you could call this a performer, is cash because it didn't lose value in all this downturn.
Mm.
So that
Mm-hmm.
was one area as well
Mm-hmm.
that kind of provided protection for your portfolio. And the top performer, like you mentioned, has just been the commodity space as well, where all the other asset classes have been experiencing some significant losses in the first half.
Yeah, it's been a
Hmm.
really, really rough year. Different inputs, but it does remind me of a little bit of 08, 09, and late third, fourth quarter of '08 and '09, where pretty much everything was going down. So as Adrian said, it was cash, and then Eric, you mentioned commodities, and that's kind of it as far as things that have held their value and gone up. And I've been just looking at and trying to figure out what is this compared to get some kind of reference. And the closest thing I'm seeing is that 73, 74 bear market, and I'm hoping we're not going to be as bad, just because I think we've got the similarity of inflation, but we've got the difference where I don't think the oil situation is as bad, with the oil embargo going on back
It's interesting that you brought
Hmm.
that up too, Roshan, because I recently got this question: what's going on now, and how does it compare to 2008? And if you just look at the overall market, there is a downturn, so it's similar in that regards, but I guess different catalyst to these events is the real indicator on why they're different. Where 2008 was more of a weaker financial system where certain
then.
banks didn't have to pass stress tests. It was mostly centered around housing and bad loans. Where now this catalyst with the market being pulled back is due to a war overseas, inflation, supply chain issues brought forth by COVID. So it's similar in the aspect of the market is going down, but different on what the causes are. But I'm sure there's a lot of other things. What kind of would be your response to how this is different than 2008, other than some of the
We
stuff I brought up?
Well, and that's why I'd compare it to 70, 73, 74, because I feel like the inputs or the causes are
Hmm.
similar.
With
But in
inflation,
in
yeah.
yeah, with it being inflation, and then you've got the oil issues. Now, granted, oil isn't just inflation; it's Russia, Ukraine as well. But I looking at those being the major cause. To me, the causes are inflation and the Fed raising rates. Now, granted, they have to raise rates because of inflation, but they would have had to do that regardless at some point with this loose monetary policy they've had for arguably over a decade, right? So they've got to make some shift there. The other thing I will note that makes it different from '08 and '09 is, as you both know, and I'm sure our listeners do that have listened to our episodes, I follow the Treasuries very closely, and in '08 and '09, they did what they were supposed to in the sense of being a hedge. They were up over 20% in '08, whereas this year they're down about 20%. So typically where people flock to quality. Eric, you mentioned bonds, but this is going more into more of specific bond space. But you've got the thought being people flock to quality when things go down. You get scared of stocks, you go to bonds, specifically treasuries, and that's not happening this year, which is very rational because as interest rates go up, bonds go down. So it's not a surprise they're sort of falling in line. Comparing that to '08 and '09, where you've got the financial crisis going on, and there the uncertainty. I would argue that was a lot scarier a time because at one point the most bearish outlook was all banks are going to fail, and so
Hmm.
fortunately we're not dealing with that. We've got to deal with the inflation, which isn't a great problem either, but I'd argue that's a better problem to have than the fear of an entire financial system collapse.
Here, here. And so I'll just add one more thing to that as well. So you mentioned the 20 some percent decline in treasuries. I think you're talking about long
Correct.
dated treasuries. Of course, shorter dated treasuries haven't had that sort of price move. But one of the byproducts of that, if you think about international currency flows, is that people around the rest of the world, as they watch their own central banks and their own banking institutions still somewhat cautious about raising interest rates. As a result, then the treasuries offer many bond oriented investors and safety oriented investors a much more appealing choice for placing dollars into bonds. And as a result, when that happens, people look at the treasury paying them three, and let's say, some sort of instrument from either the European Central Bank or the Bank of Japan or what have you, paying them less than 0.5% or whatever. What happens? Well, they sell a euro or a yen in order to go buy a dollar so that they'll then have a dollar with which they can go purchase some treasuries. That also has an impact on the currency relative valuations. And the dollar is another one of the categories that has been moving up. What does that do? Well, when the dollar moves up, that makes US exports more expensive for people elsewhere because now they have to come up with their own more of their own currency to buy the same dollar denominated good or service from the United States. And when those exports decline, then so does US GDP. And that is in part what will lead to or has been leading to something of a slowdown on the economy side. Because up until now, this has been essentially a conversation about markets, but it also is a conversation about the economy.
Well, let's talk about that as far as where we are. You've shared all the data in terms of performance
Hmm.
of these
Hmm.
uh, of these different investments, whether it's indices or we've talked about commodities, cash, the dollar, et cetera. And we've talked about what some of the causes have been of this. Are there any other data points or things that you think are really valuable or of note as far as what's happened so far from our mid-year review perspective?
Yes, well, I would say one piece is the slowdown in fiscal stimulus. So when in 2021, when the various sequence of bills that we discussed at length in a number of our podcasts, the Build Back Better plan and the infrastructure plan and other things of this kind were essentially, and in addition to the various support mechanisms such as child care credits and wage support, extended unemployment benefits, many benefits of that kind. There was a lot of stimulus that was flowing into the system. We've talked in other episodes about how that fed into the inflation effect as well. Lots and lots of free dollars now sloshing around, going after primarily goods, less services. Well, some of those have fallen off. Some of those benefit programs have fallen off, and so now the federal government stimulus effect, at least on that direct level, and here's money in your checking account that we'd sent via an ACH or whatever the case might be, that's been paring down. So if you take that money out of the system, you slow exports, you have increasing interest rates, you see the housing sector starting to slow as well. There's a number of things there that are understandably leading to a prospectively lower pace of economic growth for the next few quarters.
And you're what you're saying, Eric, or let me ask you the follow-up question then. Slower economic growth, are you expecting a recession?
Well, that's a great question. So, as our listeners who follow us will know, a few weeks back we did an episode where we actually looked at this question: Are we bullish or are we bearish? And one of the indicators that we cited was, hey, there's been a lot of talk about the 10-year Treasuries interest rate versus the 2-year Treasuries interest rate. That has had inverted momentarily, and we noted that at least among people in the financial industry, that monitoring what's taking place with the relative interest paid out on 10-year and 2-year Treasuries. When the 10-year gets lower than the 2-year, that's known as an inverted yield curve, and at that point, then it's considered to be a warning about the possibility of recession. And I said, I'm not entirely dismissing that, but I do think it's important to call attention to another measure of inflation, or pardon me, recession, specifically the 10-year Treasury, not against the 2-year Treasury, but against the 3-month Treasury. That's a measure that's more favored by academics than people in the financial industry, and it has had a record of greater precision. Well, at the point in time we recorded that episode, roughly 4 weeks back, that measure was actually moving higher, meaning the 10 years interest rate paid versus the 3-year Treasury bills paid was not only the 10-year wasn't not only paying more, but it was increasing its the amount against which it was paying versus the 3 month. Well, I didn't say that sentence very well, but you get the idea. So, well, that has since reversed. And so now, and it actually reversed shortly after we hit record. So what has happened in the subsequent weeks is that now is also approaching zero. And as I checked this morning before we hit hit record, the 10 and the 2 were essentially equal, and the 10 versus the 3 month, that was coming down. So that's a long way of saying it. To me, it looks like the likelihood of a recession, possibly in late 2022, more likely in 2023. That risk now seems to me to be increased. Interestingly enough, though, of course, I'm not the only one about that. In February, there were some 400 global investors who are routinely surveyed about their outlook on all of these questions. And they were asked, what do you think the likelihood of a recession is in 2022? Only about 2% of that number said they thought that would happen in 2022. That has since risen to over 20%. 17%, I take it back. They were also asked, what do you think the likelihood is that that will happen in 2023? At that time, 29% of the 400 were saying they thought so. Now, during June, 71% of them think so. So we're seeing an unfolding of circumstances here that I think is leading everyone to pivot more and increasingly more to the view that recession is a higher likelihood than before. But that's my outlook.
Yeah,
How
I
about
think
the
one
two of you?
factor too that we haven't really touched on, I'm sure you probably have some data for this, Eric, is employment. That's got to be a big factor as well, whether we're going to recession or not, and wage growth too. That's something that I follow as well. That's also just been a hot topic that people have been looking at right now because wage growth compared to inflation and just home prices as well, I saw it compared to as well, has been pretty flat. So an improvement in that number could really help out, just see where we're headed. And I think a report is coming out this Friday, I believe, with employment numbers. So that's something too that's going to be a big factor as well, just seeing what the current state of it is.
And fellas, I've got while preparing for this, I read two things to me that makes it seem to me that it's one, unavoidable, and two, could we already be there? There are a few calls that have come out there of investment professionals saying that we're already in it in a recession. So and the two data points that have got me thinking not if but when we're going to be in a recession or whether we're there already. The first is that one, the Fed's had 13 rate hike cycles and there have been 10 recessions, right? So, said a little bit differently, almost 80% of the time when they're hiking rates, there's going to be a recession, right? The second one that stood out to me, there's a recent Domash and Summers paper that said that historically, since 1955, when inflation's over 5%, there's a 60% chance of a recession in the next 2 years. And if unemployment drops below 4%, the probability of a recession was about 70%. We've got both of those going on right now. So my perspective has, I had I'd been of the in the camp that thought we will have a recession anyway. So this could be a little bit of a sort of a feedback loop with these data points standing out to me. Excuse me. So I will readily
Hmm.
acknowledge that.
Hmm.
But when you're talking about 80% of the time, almost when you're doing a rate hike cycle, you're going into a recession, and the fact that I would argue that this is not a sort of a standard rate hike cycle because of the inflation, which is why I go back to the 70s market again. I think this is what I'll call a worse rate hike cycle than the norm. I just feel like the likelihood of a recession is once again a matter of when, not if.
I mean, it sounds like it's self fulfilling right now, where you're saying there's these rate hikes just trying to curb inflation, just doing its best to just tighten the overall economy and the markets in a way. And right now, I think Eric and I discussed this recently and actually did a search where people are, whether it's social media or whether it's just searches online, are searching recessions now more than ever. And this will cause some investors just to change their allocation as well to just try and price in. I mean, that's what people do. That's what markets do. They just try and price in what they're going to see happen in the future. So it's kind of all this searching, all this what people are talking about, and what people are doing with their assets right now that are kind of leading people into this kind of economic state, so to speak.
And Adrian, I'd say that's an additional
Well,
fear, not
mhm,
not the same one, or fear might not be the right word, but an additional data point that'll be the likelihood of a recession. I've seen that if in consumers and corporations are fearful of a recession and they spend less, that it will also cause a recession, right? So the what you had said being self-fulfilling, I think that's I would say that's an additional point, not the same one, which makes greater fear of inflation. Eric?
mhm. Yeah, I think, first of all, I'm not going to disagree with anything that two of you have just said. I think every one of those points is legitimate. I think what makes this instance somewhat harder is, we can't forget we had immediately before this a worldwide pandemic and a policy response to that pandemic, which shut down many segments of the overall economy and created a lot of disequilibria. So on that level, at least, it's not quite as normative a precursor to what's taking place right now as we would normally see. So that's, I'm not saying that undermines what you've said. I just think, to a certain extent, it confounds some of the way in which we might normally interpret or say something is necessarily then going to happen as a result of some of these signals that we've been
Hold
seeing.
on,
That's
let's
one thing.
explore that deep. Can we
The
explore that
second
a
thing
little
is
bit
is
deeper
that,
there, Eric?
okay,
Because
sure,
I would make,
yeah,
if you've got more money out there, it isn't what you just described also inflationary. Granted, it's different data points, but you've got greater money supply. That's inflationary through all the stimulus, through both fiscal and monetary policy.
hmm
So,
hmm yes, I do. Oh, that's certainly true. But I'm talking now, I think I'm thinking about this more from a
okay,
supply side. So for a period of time, remember we've said that the simple definition of inflation, maybe the oversimple definition of inflation, is too many dollars chasing too many
too
goods and
few.
services,
Yeah.
or too few goods and services. And services, of course, if you tell all the restaurants they have to shut down, and many other sorts of service businesses that they basically have to shut down, then a lot of money was flowing over towards the goods sector instead. People were ordering things online like crazy. The warehouse business was going crazy. So, but at the same time, you didn't necessarily have factory production that was keeping up, or let alone, I mean, even just right now, we have really sharp um, restraints on production in China again, a major source of world manufacturing. So that's sort of still going on, but that had been going on all over the place. If you loosen the ability of producers to actually produce, then in part you may solve this problem of too many goods chasing. Why am I having such
Okay.
trouble? Too many dollars chasing too few goods and services by just creating more goods into the system. And with that, is it possible that that relieves some of the inflationary pressure and then allows the Federal Reserve to lighten up? By the way, I just as a citizen, I hope they don't lighten up too much. I do think we need long term rational interest rate policy. And I don't think zero interest rate or near zero interest rate policy is rational long term interest rate policy. So that's a separate conversation. But nevertheless, I think it maybe starts to take some of the pressure off, because what I just said, you highlighted, Roshan, the fact that in the past, 5% or greater inflation, 4% or lower unemployment are precursors to recession. And I would say that that very well could be. But what we're still seeing is at this point, help wanted ads are the demand for people with help wanted signs are everywhere. People are clamoring to get more people in the door. And so if I would say usually what you tend to see is that people are in the past, people are fully employed, and there really isn't much more demand to soak up unemployed people or underemployed people. And as a result, the economy in one sense has no further way to grow. We're not at a point. The unemployment numbers right now are masked in part by people who have left the workforce during COVID. In other words, they're still available if they wanted to be lured back in to the employment sector. I still think there's that capacity within the economy to continue to grow. And the last thing I'll just add on this is that if you look at what S&P 500 companies are forecasting as their earnings for not only the rest of 2022 but also into 2023, it doesn't sound like they're saying that, from an earnings standpoint at least, that they see themselves in a recession. Now, they may see their earnings slowing down somewhat. That's not a big shock. I mean, golly, we had year-on-year growth rates coming out of COVID that were in the fives and the sixes. The U.S. has not been in 5 and 6% growth territory for a long, long time. So it's 5 and 6 coming out of the COVID shutdowns. That's not going to be sustainable long term. So I'm not surprised that there's some cooling of that growth rate. But I'm not sure, on the basis of a lot of surplus labor still on the sidelines, people clamoring for help, and they're forecasting their earnings are still growing in 2022 and 2023, that necessarily is the kind of setup that you normally associate with recession. So that's what leads me to still have some degree of uncertainty and skepticism about all.
Yeah, well, and I'm trying to find the data, the source of this, but I believe there's a tracking of earnings revisions, and I believe we're seeing a significant amount of revisions where corporations are pulling back earnings. Now, I hope I'm wrong, and there is no recession. It's better
Mm-hmm,
for the
mm-hmm,
country, better for us individually, if I'm wrong on that. But um, I would
mm-hmm,
agree
mm-hmm.
with you that there has been definitely constraints on the supply side. I just don't think that it that itself will resolve inflation. And in my mind, getting inflation under
Mm-hmm.
control is the driver of everything, because the Fed's going to raise the rates and so on. So
I'm with
I
you.
think that'll help.
Yeah. Mm-hmm.
I think that'll help a few months down the road, which is why I would agree with you. And you didn't say this, but I think you tell me if I'm putting words in your mouth. That the inflation number around 9% is a little overstated, partly because of this supply chain issue. I would agree with that if that's what you were
Mm-hmm.
saying. Tell me if I'm wrong. However, I don't think that resolves it on its own, particularly if you think of the Fed's target of getting inflation down to 2.5.
Well, I'll agree with that. Should say, we look at a number of measures of inflation, and some of those measures include energy and housing, and others do not. So we've talked a lot about the CPI and the
Core,
eights that we're seeing in there. Another version, though, that we have cited from time to time, and which is also, I think it's at least worth noting that it exists, is the personal consumption expenditures, the
yeah,
PCE. And that's a little bit more core type of measurement as opposed
it
to
is.
some of these other things. I'm not denying that energy and housing and such play a role in people's actual household budgets, but in terms of trying to understand what's going on in the rest of the economy, that's not been two, but it hasn't been. It's been south of five. I
No,
think it's
well,
around 4 3/4, if I'm not mistaken. So, in some ways, it's not like we're so far from getting inflation under control as we might once have imagined that we were. Now, but
well, hold
I'm
on,
with
Eric.
you,
Let
Roshan.
me
I'm
give you
an
some of those.
inflation hawk.
Let me give you some of those numbers. I'm sorry to cut you
Sure.
off, just because I think you. Yeah. So the Fed's mandate is to get that personal consumption expenditures, get that index to 2. Um, for May, it looks like it was at 6.3.
I have core CPE for May year on year was
No, no,
4.7.
personal consumption expenditure and CPE are different data points.
I'm talking about core PCE,
Uh,
CPE,
yeah, and that, but
PCE.
that,
Sorry.
and let me give me a second to look that up. Um, Core PCE right now is the Fed's favorite measure. I believe you're right on that one. I was looking at overall PCE, but I still can't find it. Please continue. I'll try to find this
Okay.
number
All right. Well,
as we're
maybe I'm
going
off on
on.
my numbers. I hope I'm not. I thought the June numbers
4.7.
shut me
Oh, I just
4.7. I
found it.
think I said
Overall
4 3/4.
PCE. Yeah,
Yeah.
overall PCE is the was the 4.7 number, and uh hold on, let me make sure. Let me read this out. Uh, yeah, the excluding food and energy is 4.7, including food and energy is 6.3. These are both
Okay.
May data points.
Yeah. All right. Well, so, but bottom line is that I think increasing. So just to kind of summarize where we are in this conversation about recession, I do think that increasingly it's the things are pointing that direction. I don't deny it. There's no denying that they are. Number two, I do think that though the impact of COVID shutdowns and now coming out of those shutdowns is both uh, confounding what has happened and may to a certain extent be confounding what is currently happening. And so it's not as quite as straightforward to me that you should read all of those indicators in quite the same way that we otherwise might normally do. I will say I do see some signs that concern me, but I also see some things that encourage me. And so on that basis, the picture is not blindingly clear to me that we're in for a recession, and if we are, that it's going to be deep and deeply wounding to the economy. It may be that yes, it qualifies as a technically as a recession, but in terms of its overall impact on people's welfare, may not be as deep and profound as some past recessions have been.
Yeah, that I would tend to agree with you actually on that. I think a recession, uh, as defined by two consecutive quarters of GDP contraction, uh, is expected. I don't think
Hmm.
it'll be as deep either. I do think we've got a stronger economy, and I do think, as you mentioned, with the supply chain, with the employment numbers and so on, I think we will. Hopefully, it'll be quick, and we'll come out of it stronger. I think we'll come out of it stronger regardless. I just hope that happens quickly.
So let's talk about what the implications of these and how investors ought to respond. What are your thoughts about that?
Well, I mean, I'll what I'm
Or would you
looking
like me to
at.
start?
Oh no, I can. I'm happy to go.
Okay.
What I'm
Yeah.
looking at when you take it to the next step of what can investors do about it, or where can they start, because I am bearish right now, my first
Hmm.
first thing I would tell investors to be patient, right? And
Hmm.
what I mean by that specifically is you're coming off of the last time people have seen a market decline, and people have very short memories on things like this, was the fastest decline and fastest recovery in history, right? So
Hmm.
I think what people are thinking, all right, it went down again. Why isn't it up already? It was up already last time, this quickly.
Let's be
And
specific. We're talking about the 35% peak to valley decline in the S&P 500 and much more significant peak to valley declines in other equity indices in March of 2000. And from late February, mid to late February of 2020 to early March, late March, I should say, of 2020 as well. And then the rebound. That's the downturn that you're referencing.
that's exactly what I'm referencing, and I think I don't think it'll be bad as the 70s market, but that was a 21-month decline and a 69-month recovery time. I don't think our
Hmm.
recovery time is going to be as long, uh, but I believe the average numbers, and Eric, hopefully you have them memorized, so you can tell me if I'm wrong, is about 18 months peak to trough on the decline side. These are averages, and then recovery is about 2 years, 24 months. So uh, if I think that we'll be closer to the average than we will be to that 69-month recovery that the 70s market had, but
Hmm.
uh, I don't. So I don't think it's going to be as bad.
Hmm. Well, Adrian, by the way, in one of the episodes where you were gone, did talk about the normal extent of the decline and the normal time to recovery. So you're right in the neighborhood, according to what Adrian had done is his research previously. I agree with you that I don't expect it to be as deep and as wounding as some. And now the question will be, what exactly does that look like? I also love your point about being patient. So, in fact, in conversations with clients, depending on their time horizon, depending on how long it is until they have to spend what they have, in some cases for younger clients with long runways, I'm just saying, hey, this is just part of the process. Just keep saving, dollar cost averaging. You're buying shares at lower prices. That's a good thing in the long run. This will work to your benefit. Whereas for some of our clients who have tipped into the area where they're no longer accumulating and now they're decumulating, particularly if they have more of a nervousness about some things. I've actually been saying, let's scale down your net equity allocation to somewhere in the neighborhood of 20% in some cases. I'm not negative, and I'm certainly not flat, but I'm certainly much, for those clients at least, quite open to having a conversation about a lower equity allocation. And that conversation's been going on for a while. But in terms of
Well,
looking
Eric, I got a
ahead,
question. I'm sorry to interrupt your
yes,
flow, but
go
I got
ahead.
to ask you.
Hmm.
So if
Hmm.
someone says to you, well, first, is this a strategic or tactical? Are you lowering their equity exposure permanently or just until you see an opportunity to shift?
Tactical.
Okay, so at some point you'll see bringing it back up. Now, the
Hmm.
follow-up question I have for you is, what is your response to someone who says, an old market statement, which is, well, if you don't sell, you haven't lost. So I'd rather just hold on to it and wait till it recovers. What's your response to that?
Oh, I think, and as I said, I'm having that conversation with those of my clients that have more of a discomfort level
Mhm.
with all of this. For those of my clients that say, "Hey, this is just part of the journey," even if they're in those decumulation years, and there's a very healthy ratio of assets and guaranteed income from Social Security or possibly pensions to their actual spending, yes, then I'm not in suggesting that they completely derail that plan.
Well, no, more to
But
those ones because
mhm,
I actually am with you. I'm just curious as to your response to that versus mine. So you've got someone that's pulling money out right now for their
mhm,
retirement, and you're
mhm.
telling them lower your equity exposure right now. So in that specific case, and they say to you, "Well, Eric, I've heard the general rule is don't sell when it's down." What's your response
Mhm.
to that?
My response is, if we do this as a tactical thing, I want you also to be ready as a tactical move to, when the opportunity comes, to not sit on the sidelines and instead re-engage and be opportunistic, not necessarily just pedal to the metal, 100% equities, but in the same way as we're dialing back some of your equity composition in your portfolio now, then please be ready as we have this ongoing conversation to up that when the opportunity strikes. And as we've talked about in some previous episodes, one of those signals for me is actually less about what's taking place on all of the measures that we're talking about, economy and the stock market itself, and instead it's watching what's taking place in the bond market, and specifically it's watching what takes place in the high yield bond market relative to the treasury bond market. And when it becomes increasingly evident to me that a lot of the fear is dissipating there, I think that has been a good indication that it might be time, maybe a little early, maybe a little late. It's never going to be perfectly timed, but it might be time to say, okay, for a period of time, we have an opportunity where probably small cap value, in particular, those distressed companies that got probably hurt the most during the downturn, are the ones that are going to come back the strongest. And so let's tilt the portfolio to a greater extent in that direction at that time than we might normally do as a long-term strategic policy position.
Yes,
Yep.
diversifying within asset classes is extremely important. Just upgrading the portfolio. Like you said, if you're shifting more into equities, just look in the different asset classes because there's small cap, mid cap, large cap, emerging markets, domestic. Just look upon all those different areas. And two podcasts ago, Eric, we discussed the bond portion of your portfolio. Look at the overall duration as well as an important factor now, just with the changing market environment, just diversifying within those asset classes and just looking to upgrade is more important than ever.
Well, I agree with you about the diversification piece. In this case, I'm talking about, though, sort of a temporary policy position, or a temporary tactical position, as opposed to a long-term strategic policy position. So my long-term strategic policy position is pro diversification. But
Yep.
what I'm talking about here is a tilt that for the time being, especially for that subset of my clients, where, as I described, they're in decumulation and they're feeling particularly keenly unnerved by all of what's going on about them. Then in those cases, I'm saying, all right, well then we can tilt down to less equity, but let's be prepared to have a reciprocal move later when the opportunity is knocking, to then go the other direction and go slightly more in the direction of equities, specifically small cap value, than you might otherwise be normally inclined to do from a long-term policy perspective. Roshan,
One note I want
you
to
like or
add.
don't like that idea?
Oh, personally, I love it. I'm on board. I'm doing something similar. But one thing I do want to note for all the listeners is these are not moves we're making because we have a feeling or have some thought. We've got rules behind them.
Hmm.
So I only say that because if this is something someone as a listener, and we have to give you disclosures because we're all licensed, we're not recommending anything, we're just sharing our thoughts, etc. And hi to Kari, who's our compliance, that's going to listen to this for us. But so, but what I'm saying to the investor is you want to protect yourself from yourself. What I mean by that is have
Hmm.
rules. I've
Hmm.
met people many times. I really remember this in '08 and '09. You know, we're fast forward. You know, markets crash '08 or '09. Someone gets scared and goes to cash. I see them in 2012, 2013, and they're still in cash. So they
Hmm.
miss
Right.
this huge opportunity. So if you're going to do some of these tactical moves, Erik mentioned the data point he uses with the high yield bond spreads and looking at those. If you're going to make some of these tactical adjustments, make sure you have rules and not just opinions on these ships because I've got rules and I've got opinions, and the rules have been different from my opinions in the past. And there have been some cases where my opinion were right, some cases when they were wrong. But I'll tell you, following those rules that you have that have a historical track record of doing well, I'd like to think those would be the rules you'd follow. It will really empower you and make you feel comfortable in making those decisions.
Yeah, not to just state a bunch of platitudes, but I completely agree with you. What you just said, that rules, not emotions, have to be the source of your disciplined approach to investing.
Yeah, and so let's continue on with what we've got. What can you do about it from the investor's perspective? We had said be patient, lower equity exposures now with the plan to increase it later. Adrian mentioned diversify. Gentlemen, what else would you suggest?
Well, let
What
me
else
just
can our listeners
qualify.
do?
Yeah, let me qualify one thing. I wouldn't say, as a rule, go out and lower your equity exposure right now. I would say,
Mm,
if circumstantially you're one of those that is particularly, particularly unnerved by all of what's going on, and you have your plan would be vulnerable if saw, for whatever combination of reasons, you didn't have a well diversified portfolio to begin with. And I'll actually want to talk with you about a scenario there in a couple of instances. But this might be the time to say, okay, I will, if I can commit to doing the opposite when the time comes, that specifically that I will increase my equity exposure when the opportunity strikes, then I will allow myself to dial it back a bit now. And my approach isn't to dial it to zero. I don't believe in the idea, go to all the cash. I think that has just been over and over again, not done well. I'm not saying it theoretically, it's not a good idea. And then incidentally, this is just as an aside, as I've mentioned with you gentlemen in the past, and for our listeners in the past, I run some technical and quantitative and algorithmic strategies, a couple in the stock category and one in the momentum and using exchange traded funds. That recently has just moved to basically cash and US dollars. And there's a little bit more than that, but it's so in that sense, having a sleeve which is tactically governed that may actually move all entirely out of equities, as it has done, is I certainly grant that, but I'm talking about the entirety of your portfolio. Moving all to cash to me seems, unless you're doing that in a disciplined way and you have a rule that will get you back in, as opposed to waiting till your emotions signal that you get back in. I think then I think that's a mistake if you're emotions driven in that area.
I like that additional point too. Is with any of these adjustments, uh, you if you do it with all and you're wrong, it's a huge pain to get
Hmm.
back the other
Hmm.
way. And what
I want to
other?
throw out a scenario
Yeah.
for you and ask you, because this is right to your question, Roshan, but it's looking at it from the vantage point of an actual client. Um, I've had some conversations, let's say, with some prospective clients that have been just all in and thought I was a knucklehead for not having every penny essentially allocated to the FANG the FANG stocks, or I'll call them the FanMag stocks. So that would be Facebook, Apple, Netflix, Google, Amazon, and Microsoft, and stocks of that kind. And why invest in anything else? That's where every dollar that I have should be invested. And if you're going to recommend to me any sort of international or small cap or any of these other things, you're a fool, and I don't need you commenting on my portfolio. So now, of course, there's a lot of second guessing on the part of some of those listeners who may have made that exact choice in their portfolio. What would you say to that listener?
Well, I think first it goes back to what Adrian said earlier about being diversified.
Mm-hmm.
And to me, that's a conversation of a risk, right? If that's what you want to do, okay, are you comfortable with the risk? And then I'd probably look back, and I don't have the data in front of me, but I'd look back to the tech bubble decline, and I would also look at what's happened this year and what's going. I don't have the exact performance of those stocks this year, but and then I'd say, okay, obviously, if you're looking at this year, it's a little too late to do. So prior to
Mm-hmm.
this decline, I
Mm-hmm.
would have looked back
Mm-hmm.
at 2000 and said, okay, are you comfortable with and can you survive this kind of decline? And if the answer
Mm-hmm.
is yes, I'm fine with it. Um, that I think it's their portfolio and that's acceptable. But I would also first lean towards being more diversified. But at the same
Yeah.
time, I don't. I wouldn't have a hard no, you shouldn't do this or a strong yes, you should. I think that's very individual. And I don't think most people can handle that level of risk, but the person you're speaking to, they might be able to. And if they're able to handle that risk, let's do that. So Adrian and I met with someone recently that had um, 80-90% of their portfolio in only one of those positions, and
Mm-hmm.
we've been talking to them about how to manage the
Mm-hmm.
risk of their portfolio. Great timing to buy. Bought in 2000, has done really well, and literally one of those stocks, and it's grown so much that their plan is to hold it till they pass away, so their kids get to step up in basis, which all
Mm-hmm.
works. Fortunately, in their position, they do have other assets though. That one position
Mm-hmm.
is about 80% of their wealth now, but that wasn't when it started. So
Mm-hmm.
we've gone through all the scenarios, and in that specific person's case, they're fine with the volatility. Part of it could be hubris because they're of the opinion that this stock can't go down, huge amounts. But part of it is, well, even if it does, they don't need the money. It's going to their heirs anyway. So I
Mm-hmm.
think you've really got
Mm-hmm.
to look at that person's specific situation. So to me, that's not just an investment question; that's an overall portfolio question.
All right. Well, I agree with that, and so I would say that the scenarios in which I'm thinking about this, and it's more than just
Mhm.
one instance, is more. It's an investment belief. So we all have beliefs, and their decisions about this were rooted in their beliefs, and now those beliefs are being tested, and so they're asking, where was I wrong? How did it come about that this substantial share of my wealth, which I had earmarked as this essentially the source of my having a very enjoyable spending opportunity and during my retirement, has now the ground has shifted so substantially. So I'll answer the question that I posed. What would I be talking with this client about possibly doing? It kind of again depends on their plan, and I love the fact that Adrian over and over in his input for our podcast will return to the question of what does the plan show.
Yeah.
But if your situation is now such that you've seen such substantial declines in the value of those high growth tech oriented positions, and at this point you're wondering, okay, now the math doesn't work for the retirement any longer, do you just sit and wait? Well, one step you might consider doing is, yes, sitting and waiting, and but in the meantime possibly either trimming your expenditures substantially or going back to work for a while. I mean, that might be the approach that yours is. It's less an investment strategy than it's an overall financial planning strategy. But if you're saying that's not realistic, I'm not going to do that, then another option is this is a double meaning on this word. Another option is options, and that is to use
Right.
some options to, on the one hand, protect your portfolio on the downside from possible further damage, but also to start writing calls against your position so that you're generating some sort of income against that concentrated position. And there's no one who's probably better qualified among the three of us to talk about that than Roshan. Your thoughts about that approach?
Actually, Eric, that was my next suggestion. I was waiting
Oh,
for
was
my
it?
opportunity
Okay.
to mention that, but my question was going to be, can they generate enough income on their covered calls? Can they write covered
Mm-hmm.
calls to generate enough income to meet their needs? So
Mm-hmm.
if they can, then maybe their retirement is potentially still on track. Now that
Mm-hmm.
what I've seen, and this is specifically going to that one person I mentioned with 80% in one stock, just because this is so
Mm-hmm.
recent. We had this conversation last week. Is
Mm-hmm.
in that one specific case, it's definitely anecdotal. It doesn't apply to everyone. Um, his belief is, yeah, I could write covered calls, but because I think the stock is going to go way up, I want to write it really high. Right, so we
Mm-hmm.
went on and we actually created a ladder for him of writing covered calls at various prices at various dates. He decided to think
Mm-hmm.
about it, came back a month later, the markets dropped, and he lost out on about $50,000, right? So
Mm-hmm.
in his specific case, once again, he doesn't need the money, but now that the stocks dropped and he's missed out on that one opportunity, well, the covered call ladder at those prices have also gone way down for the future. So
Mm-hmm.
it's hit them both ways. So I would look at their portfolio and say, okay, what can I generate in covered calls, and make sure they fully understand. Hey, if the stock goes through this price, you're locked into selling. So I'd also want to look at the tax consequences of that. But when you consider those different pieces, can that covered call income meet their retirement? If the answer is yes,
Mm-hmm.
and they're saying, well, hey, but I don't want to sell it at this price, my response would be, is it more important to generate the income you need so you don't have to go back to work, or more important to keep the stock and go back to work? To me, it sounds like
Yeah.
those are the data sets, or the important data
Yeah.
points there. Um, I'm hoping that there is a good solution that they have where they have some flexibility. We've talked about this in many episodes in the past, but I very much view, um, uh, when we're working with the client, we want to make sure they can maintain their lifestyle regardless of what the market does. So I'm hopeful that they're in a position to do that versus extending it. Are they retired, or are they currently working?
In both cases that I'm thinking of, where there's been this passionate commitment to that allocation, yes. Hmm.
They're both retired. So, and have you
Recently retired.
recently retired? Have you run the analysis on those stocks to see those calls to see if that can meet their income needs?
No, they won't let me because they told me essentially that I was foolish to suggest diversification, and they didn't want to continue to work with me. So,
Yeah, well,
but so on that basis, they're feeling like there's, I think, a deep embarrassment on their part that they've allowed this to unfold in this fashion, and so they just don't want to sort of step back into the conversation to only feel like, whether I say it or not, to worry that I might say I told you so.
you're right. I can see that. Well, I'm hopeful they know about covered calls, and so that
Yeah,
they
I
can
hope so too.
potentially generate their income. I just
Well, I talked with them about it, in prior times, but
yeah
it seemed to them ridiculous then.
yeah
So I've got one more question.
yeah
So now crypto has gotten completely battered,
yeah.
and I'm sure you have, and I certainly have, both prospective clients and some actual clients that have seen some pretty significant losses on their crypto positions. What would you be saying to that crypto investor?
And I hate that my response to you always, it seems to be like something you should know in advance. But I'd want to look at their look in advance, make sure that it's not too much or overweighted too much in their portfolio. Can't do that now, obviously. Depending on where it stands as part of the portfolio, I think it's a discussion of their belief in it, right? If you're a real believer, is this a buying opportunity? It's easier for me to say this about a stock because with the stock, that's an ownership in a company, right? So if you're a believer that this company is like you mentioned the FanMag stocks. If you own Google, for example, if you're a believer that Google is still a good company, it's going to grow, there's data points and metrics behind that where I think you could feel comfortable either owning it, buying more, doing something like that. Or even if you wanted to make an
Hmm.
argument to sell. With crypto,
Hmm.
because it's not a company or a business, and there are definitely arguments for the utility or not of crypto. I think you've got to decide what your stance is. And if you're still
Hmm.
a huge believer in crypto, it's potentially a buying opportunity. If you're not a believer in crypto, hopefully it's a small part of your portfolio. Do you take a loss, sell, and move on? Or if you're sort of undecided, once again, if it's not a huge chunk of the portfolio, can you take the position to just hold what you have and wait and see what unfolds going forward?
Hmm. Well, I'll tell you, I recognize precisely what you've said is true, that there isn't the same sort of underlying business case for the cryptocurrencies, it seems to me, as there is for, let's say, this or that company that's taken a deep, deep blow during this downturn, because the latter, namely the company, has income, presumably revenues, sales, profits, etc. Whereas in the other case, it's more of an argument for store of value or potentially a medium of exchange, and to a lesser extent, it's predicated on a technology that will have an increasing penetration into lots of areas of the world economy. But I would say, if you look at crypto being down 70%, Bitcoin at least being down 70%, if you have been thinking about entering into the crypto world, you're probably, it's better at your it's more advisable to start thinking about that probably when you are 70% off the peak than when you're racing toward some sort of peak.
Agreed.
So that's not advocating that you rush out and buy Bitcoin, but I'm saying that if you've been thinking in those terms, you might want to start looking at that now with a little bit more focused
Than
attention.
before. I agree with that. Just to put it in perspective, by the way, I'd have to compare this to be sure, but I believe Netflix stock is now more than Bitcoin. Right? Just
Mm,
just to put it into perspective. Two totally different things, two different, totally different situations as to what's going on with each of them. But I only make
hmm.
that
Hmm.
point to say that it's not like the decline in Bitcoin is foreign to everything else going. The rest of the world isn't up 80-90% and Bitcoin's down 70. It's actually down in
Hmm.
line with some other big name stocks that you've heard of. Yeah.
Speculative stocks.
Yeah,
Hmm.
very much so.
Right. Hmm.
So, gentlemen, just one last thing I want to touch on, and then we'll wrap it up. Um, any other thoughts or advice? We've got be patient. If circumstances suggest this, lower equity exposure, making sure you're diversified. What other thoughts or what else can listeners take away that's actionable right now?
Plan.
You know
If
what?
you're not working with a good financial planner, get with a good financial planner. And I'm not saying that as a sales job, although we do that for a living. And if you aren't working with someone, you absolutely are free to reach out to us and have that conversation. Yesterday, as an example, I was going through this process with one of our clients using this certain financial planning software that answers the questions that she's trying to ask: is how big in a spending adjustment will I need to make if uh, I retire with this base of assets and with this amount of Social Security and with this level of expenditure and so forth. What's the prognosis for me making it to the end of my life? And if you're telling me I probably will have some spending adjustments, how often and of what magnitude? And if you have no clue about that, because you are as our listener, because you haven't done any planning, then I strongly urge you as a solution here to get in, dive in, roll up your sleeves, and get with the planner and do that properly.
Yeah, and that's a great suggestion. I actually think I take that for granted sometimes because we do it.
Mm,
You do that all the time with our clients and
hmm.
update it. Adrian, you do a really good job of taking us back to that. To me, that's sort of like the lighthouse you're driving towards, or
Hmm.
is really your core with that plan. So a lot of what we do is we will dynamically update our clients' plans at our meetings. That's just routine. So we
Mm-hmm.
literally look at it typically at least twice a year. So what we're seeing now is what has the market decline done to your future plans. And
Mm-hmm.
fortunately, in most cases, we're seeing that not much, and you can wait it out, right? There
Mm-hmm.
are some people, particularly the ones that are years away, that are planning long term, where we're seeing things like, okay, well, save a little bit more for your retirement. You know, those who aren't retired yet, or education, or something like that. And usually, by capturing those things early within the plan, those numbers are small enough where they can make those adjustments, right? Versus seeing
Mm-hmm.
it years later. And then the other advantage that does is that naturally has you adding to the down market if you've got to add to it or increase your savings, which takes me to another point I'll add to this list of what you can do about it is I'll add I've mentioned this before, but rebalance your portfolio. That's a way
Mm-hmm.
from you take all emotion out. And just to explain rebalancing, let's just say your target is to have half stocks and half bonds. Stocks have gone down. So now they're, instead of your portfolio being half stocks and half bonds, they're now down to, let's say, 60% bonds and 40% in stocks. That's a natural way where you'll sell those 10% in stocks, buy 10%, I'm sorry, 10% in bonds, buy 10% stocks to get you back to 50-50. You don't have to think about where you think the markets are headed. You're buying the asset class that's been beaten up naturally, so you're taking advantage from a long-term perspective, I think, of the markets. And this is something that in highly volatile markets typically proves to be the most profitable. When you smooth it
Mm-hmm.
out, I've done an analysis on this a few times, and usually somewhere around every 2 years or so is when it's optimal. But in particularly in highly volatile markets, it makes sense to do. I've also mentioned this
Mm-hmm.
on previous podcasts. We did this 3 times in the fall of '08, right? Just in that one, and it wasn't one quarter because it was part of quarter three and part of quarter four, but within a 3 month
Mm-hmm.
time frame, we did that about 3 times in '08 with the market with not going through the whole list, but with Erik going through performance in the first half a year, with us having multi-decade poor performances for a variety of asset classes, I think it's a potentially a great opportunity to look at just rebalancing as being an easy way to try to take advantage of this. Once again,
Mm-hmm.
not advice, just an idea. Please look into it yourself and do your research.
Mm-hmm.
Gentlemen,
Here, here.
anything else to add as we wrap this up to what listeners can do about it in this market? Be patient. If circumstances suggest lower equity, diversify, redo and update your financial plan, rebalance your portfolio. Anything else to add? I think we'll come back and revisit this topic because if we are seeing similar outlooks to what we've discussed, this may not be the end. I hope we're wrong, but I think we think there's still ways to go. So we'll come back to it. To all of our listeners, thank you for joining us. It's a little longer than we normally like to go, but I think we had a lot to add, and we were all excited about the topic. We've got another great episode for you next week on the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, tell your friends and family about us. Thank you for listening, and we'll be back next week.